Farmers who once built their livelihoods around John Deere are now turning away in record numbers, signaling a crisis far beyond just one company. This shift threatens the stability of the $34 billion U.S. farming industry. In this video, we'll explore why farmers are abandoning John Deere for the first time in history, how corporate greed is crushing small farms, and how a global takeover could push American agriculture to the brink. For decades, Deere's factories provided thousands of well-paying jobs in farming towns across the country, supporting entire communities. Today, many of those jobs no longer exist. Since 2015, John Deere has laid off more than 4,500 workers from its U.S. factories in towns like Waterloo, Iowa, and Moline, Illinois, where communities were built around Deere's plants. These job cuts had an immediate and devastating impact. The effects go far beyond just lost wages. When John Deere shuts down a plant or lays off workers, it triggers a domino effect. Local businesses suffer as restaurants, grocery stores, and small shops lose customers. Housing markets decline as fewer employed residents lead to dropping home values and forced relocations. Schools struggle as public funding tied to local tax revenue dwindles when families leave town. Other industries hesitate to invest in areas where job security is uncertain. John Deere attributes these job cuts to declining equipment sales, but the reality is more complex. Farmers, squeezed by low crop prices and rising costs, are delaying or canceling purchases of new tractors. This downturn in sales causes factory slowdowns and layoffs. The worst part, the layoffs show no signs of stopping. The latest wave of job cuts in 2024 left 200 workers unemployed in Iowa alone. And as farmers continue to face financial hardship, Deere's downsizing is likely far from over. For rural America, these job losses are more than a temporary setback. They mark a fundamental shift in the farming economy. Towns that once thrived because of John Deere are now struggling to survive. And for many families, the damage is already irreversible. But the layoffs were just the beginning. What happened next ignited a full-scale revolt among farmers. Imagine purchasing a brand new tractor, only to realize you can't repair it yourself. Even a simple sensor replacement or software update requires a visit to an authorized John Deere service center, where farmers must pay thousands of dollars in fees. The reason? John Deere has locked its equipment behind a digital barrier. Modern tractors are now software-dependent, meaning even the most basic repairs require access to Deere's proprietary diagnostic system. Farmers who try to bypass this system or seek help from independent mechanics risk voiding their warranties or even being locked out of their own machines. For many, this feels like outright extortion after spending hundreds of thousands of dollars on equipment. They don't fully own it. The backlash has been swift. Across the country, farmers have organized protests, filed lawsuits, and pushed for legislation demanding their right to repair their own machinery. The right to repair movement has gained momentum, with states like Colorado passing laws requiring Deere to ease its repair restrictions. But for many farmers, these changes are coming too late. Frustrated with John Deere's control tactics, they are actively seeking alternatives. Brands like Kubota, AGCO, and Case IH are attracting customers by offering equipment that farmers can repair themselves. Even more surprising, some farmers are turning to imported tractors from overseas, seeking brands that provide repair freedom at a lower cost. Deere's unwillingness to listen to its customers has driven thousands of once loyal farmers away. And if this trend continues, it could have long-term consequences for the company. But John Deere's biggest threat may not come from its own customers. It may come from China. Companies like YTO Group and Zoomlion have been rapidly expanding their global market share, producing tractors and harvesters at half the cost of John Deere's models. While these machines may not be as technologically advanced, they offer affordability, easy repairs, and widespread availability. Three things that John Deere can no longer guarantee. But it's not just about equipment. China's agricultural boom is driving down global crop prices, further squeezing American farmers. Since 2022, corn prices have dropped by 37%, soybeans by 24%, and wheat by 35%. For struggling U.S. farmers, these lower prices mean shrinking profits, making it even harder to justify spending hundreds of thousands of dollars on John Deere tractors. Many are now seriously considering Chinese-made alternatives as a cost-cutting measure to stay afloat. If this shift continues, it could pose a long-term threat to John Deere's dominance in the agricultural industry. Once an undisputed leader in the global market, Deere now faces the risk of losing its grip as farmers increasingly turn to cheaper, foreign-made options. But beyond the technology and economic competition, the company is also caught in a political firestorm. When John Deere announced plans to shift part of its manufacturing to Mexico, the backlash was immediate. Farmers, factory workers, and politicians saw it as yet another example of a major American company choosing cheaper foreign labor over U.S. jobs. While public outrage was expected, the most dramatic response came from Donald Trump himself. At a campaign rally, he issued a stark warning. If John Deere follows through with its outsourcing plans, they will face a 200% tariff on any equipment manufactured in Mexico and imported back into the U.S. This was more than just a political statement, it was an economic ultimatum. Trump had previously used tariffs to pressure companies into keeping jobs in the U.S., successfully deterring some automakers from outsourcing production. Now, he was applying the same strategy to John Deere. The logic behind the threat was clear. If Deere moved manufacturing to Mexico, the tariffs would make their equipment too expensive to sell in the U.S., forcing the company to either reconsider its decision or take a financial hit. For farmers, this was a double-edged sword. While they supported keeping jobs in America, higher tariffs could make farm equipment even more expensive, further worsening their financial struggles. But Trump's threat didn't just shake up the farming industry, it sent shockwaves through Wall Street. Investors worried that if Trump's tariffs were imposed, John Deere's supply chain could unravel, sending stock prices into freefall. The uncertainty alone triggered a 1.5% drop in Deere's stock during after-hours trading. While that may seem like a minor dip, in the high-stakes world of corporate finance, even small losses can rattle investor confidence. With Trump leading, in early election polls, Deere now faces a crucial decision: abandon its outsourcing plans or risk financial and political turmoil. If Trump wins the presidency again, will he force Deere to bring jobs back? And if Deere resists, will farmers walk away from the brand entirely? While politicians battle over these questions, an even bigger crisis is looming. Beyond trade wars, technology struggles, and farmer boycotts, the greatest threat to American agriculture may come from immigration policy. For years, U.S. farms have relied on immigrant labor to sustain production. In fact, over 70% of all farm workers in the U.S. are immigrants, many of them undocumented. Now, with stricter immigration policies on the horizon, farmers fear that their already dwindling workforce could disappear entirely. If deportations or restrictions accelerate, farms will struggle to harvest crops, leading to food shortages and price spikes. The problem is already unfolding. In California, Florida, and Arizona, some farms have been forced to leave crops rotting in the fields because they simply don't have enough workers. Without immigrant labor, the cost of hiring American workers would skyrocket, making food production more expensive than ever. For John Deere, this labor crisis presents another major challenge. If farmers can't afford workers to operate machinery, why would they invest in new tractors? A shrinking workforce could mean even lower equipment sales, hitting Deere where it hurts the most. Its bottom line. As if that weren't enough, another factor is reshaping the global farming industry. American farmers are producing more food than ever, but their profits are collapsing. Since 2022, corn prices have dropped by over 30%, soybeans by 24%, and wheat by 35%. For small and mid-sized farms already operating on razor-thin margins, this trend is pushing them to the edge of financial ruin. At the center of this crisis is China's shift toward agricultural self-sufficiency. For decades, analysts predicted that China would become one of the largest importers of U.S. agricultural products. American farmers were once promised that their crops, especially corn and soybeans, would always find a reliable buyer in China's expanding economy. But rather than depending on U.S. imports, China has poured billions into its own agricultural sector. With government-backed initiatives, advanced farming technology, and the rapid expansion of domestic production, China has significantly reduced its reliance on foreign food supplies. As a result, demand for American crops has plummeted, leaving U.S. farmers scrambling to find new buyers. This shift has thrown global markets into turmoil. The United States once dominated international agricultural trade, but with China producing more of its own food, American farmers are being pushed out. Countries that once relied on the US for food imports are now turning to cheaper alternatives, including crops from South America, Russia, and even China itself. Without strong international demand, US farmers are being forced to sell their crops at lower prices, often barely covering the cost of production. But the challenges don't stop at trade. Domestically, farmers are struggling with skyrocketing costs. Prices for fertilizer, fuel, and machinery have surged, making it even harder to remain profitable. The result? More farms are shutting down, selling their land, or consolidating into larger agricultural corporations. The bottom line is clear. U.S. farmers are facing an economic crisis beyond their control. If global demand for American crops continues to shrink while production costs keep rising, the very foundation of U.S. agriculture could be at risk. And it's not just economics threatening the industry. Climate change is making farming riskier than ever. American farmers have always battled the elements, but today's climate challenges are unlike anything seen before. Extreme weather events are becoming more frequent, more intense, and more devastating. In recent years, droughts in the Midwest have reached historic levels, leaving millions of acres of farmland dry and unproductive. Without enough rainfall, crops wither, yields drop, and farmers lose entire harvests. The once predictable growing seasons that farmers relied on for generations are now unpredictable, making it harder than ever to plan for a stable future. Wildfires, hurricanes, and floods are also wreaking havoc on agriculture. In California, massive wildfires have scorched vineyards and farmland, destroying entire harvests and rendering soil infertile. Along the Gulf Coast, hurricanes have wiped out crops, flooded fields, and left farmers with nothing to salvage. In the South and Midwest, heavy rainfall has caused catastrophic floods, drowning fields before seeds even have a chance to take root. Climate change is not only causing immediate destructions, but also reshaping long-term farming conditions. Rising temperatures are enabling pests and plant diseases to spread into areas that were once safe from infestation, forcing farmers to spend more on pesticides and disease prevention, further driving up costs. Many farmers are attempting to adapt by investing in drought-resistant crops, precision irrigation, and other climate-smart solutions. But these measures come with significant expenses that not all can afford. As a result, farming is becoming increasingly costly, unpredictable, and risky. If these trends continue, the future of American agriculture could be drastically altered. The U.S., historically one of the world's top food producers, may see its dominance wane as climate conditions worsen. If key agricultural regions become unviable, the industry could shrink, pushing more farmers out of business. Yet, beyond climate change, corporate control is making the situation even more challenging. For over a century, family farms were the foundation of American agriculture. But in the past 4 decades, more than half of them have vanished. In their place, large agribusinesses and corporate farming giants have taken over, consolidating land and resources at an unprecedented rate. This shift is driven by the financial and technological advantages that big agribusinesses possess, along with government policies that favor industrial-scale farming over independent growers. While small farms struggle with falling crop prices and rising costs, large corporations can endure economic downturns thanks to better financing, extensive supply chains, and access to government subsidies. They also have the means to invest in cutting-edge technology, automated harvesting, AI-driven crop monitoring, and high-efficiency irrigation systems, putting them at a distinct advantage over smaller farms. As corporate farms continue to expand, independent farmers are being squeezed out, leading to significant consequences. With fewer companies controlling more of the food supply, production methods, pricing, and even the types of crops grown are increasingly dictated by a handful of agribusinesses. This consolidation reduces competition, limits consumer choice, and leaves independent farmers with little control over their own industry. If this trend persists, the future of farming will no longer be shaped by thousands of individual growers, but by a few multinational corporations. Meanwhile, small farmers are grappling with rising costs, trade wars, corporate consolidation, and climate change. Many are being forced to sell their land, take on unsustainable debt, or leave the industry altogether. Government policies have provided little relief, as large agribusinesses receive billions in subsidies, while small and mid-sized farms struggle to qualify for financial assistance. Without access to capital, many independent farmers cannot afford the modern equipment, irrigation systems, or fertilizers necessary to stay competitive. Trade disputes have only exacerbated these challenges, as tariffs, supply chain disruptions, and shifting global markets have cut off farmers from key buyers. Without strong export opportunities, many cannot sell their crops at profitable prices, leading to the rapid disappearance of family farms. Once a symbol of American independence, these farms are now being pushed out by economic and political forces beyond their control. The question remains, can policy changes protect small farmers? Could emerging technologies and farming cooperatives help level the playing field? Or is the decline of independent farming inevitable? As these challenges mount, even industry giants are feeling the pressure. John Deere, whose green tractors have long been essential to American farming, now faces a crisis unlike any before. Declining sales, rising competition, and eroding trust among its core customers have left the company in a precarious position. The future of farming is uncertain, and with it, the fate of the businesses and communities that have long depended on agriculture. John Deere now faces a critical question. Can it recover, or are its best days behind it? The financial impact has been significant, with profits declining as farmers delay equipment purchases due to falling crop prices and rising input costs. Higher interest rates have made it more expensive to take out loans, leaving many unable to afford new tractors or harvesters, further slowing sales. At the same time, Deere's reputation has suffered due to its restrictive repair policies, which have frustrated customers who feel trapped in expensive maintenance plans that require them to rely on authorized technicians instead of making their own repairs. This backlash has been severe, pushing some farmers to abandon Deere in favor of brands that offer more flexibility and affordability.